case we need to do a clap. I think that's how they do it in the studio. So.
And we're on in
2, 1. All right, guys, thanks for joining us. Today we have a gold specialist in Hedley Widdup coming to give us his commentary on the market and what's happening out there. Hedley, thanks for joining us here at Small Cap Towers.
Pleasure, nice to see you, Philip.
Cheers. Now, what can you tell us? Gold's running very hot at the moment. You must be loving it, right?
Look, it's a fantastic environment to be looking for opportunities, particularly at the junior end of the mining market, but also for people who've got existing investments. This is the tailwind which I think a lot of people have been waiting for a long time. Not to mention gold bugs everywhere, and there's plenty of them. They all come out of the woodwork when things are like this, and they're all right in their conviction, and this is, showing them that what they've been going on about for years and years is starting to come to pass. Now, whether that's conspiratorial or whether it's actually based on fundamentals doesn't really matter. They're happy. And look, gold is driving, it's a big commodity market within the global commodity market. So when gold runs, it excites a lot of people because there's a lot of gold companies out there which are benefiting from this.
Yeah, me included. And we were recently at Diggers and Dealers out in Kalgoorlie. And what did you sense of the vibe there? Because it seemed like obviously a lot of gold companies, a gold mining town.
Look, it's a two-way vibe. You've got to put this into perspective. I think there are some wonderful macro drivers which are behind this. So I certainly don't see this as something which is going to fall apart tomorrow and then go right back to where it was. I think we're seeing a new normal, but I don't know what the new normal is going to be. There's plenty of people saying this is the start of something big. And look, I definitely buy the direction that gold has been going. But what worries me is that it's gone very, very quickly. So you go back to say, April in Australia, gold was trading in a fairly tight $8 range. And what we've seen is it's put on $200-250 an ounce in Aussie dollar terms. In fact, no, I think it might be more than that. It's probably $250 in US dollar terms in that time, and it's probably more like $400 an ounce in Aussie dollar terms in only 3 or 4 short months. So that's gone up. It hasn't really been long enough for producers to even have a full quarter of sales under whatever this new normal is. So it's been quite abrupt, and I think the feeling at Diggers and Dealers was. There's been some pretty up years in the past. 2011 was pretty big, 2007 was pretty big. But in all those cases, there was definitely a sensation of, is this as good as it gets? Whereas this year's sensation was a lot more of, well, this could be the start of something. And, maybe you're strapping yourself in, maybe you're just getting ready to realise a few things that you've been holding on to along the way. But either way, it was a sense of distinct positivity.
Yeah, no, you could definitely feel it in the press room after... You'd have the companies come in as the gold mining CEOs, and they were just like leaning back, pointing at, next question. Whereas you had the lithium guys come out and they're like, it's going to pick up. It's a different vibe. Obviously, the year before it was battery metals that stole the show, and this year it was gold. But yeah, looking at the prices, like in Aussie dollars, what we're at 2,200 plus at the moment, and in the US it's above 1,500. What do you think's been those drivers that are kind of at the moment, and kind of what people have been saying is the reason why it'll keep running?
Gold behaves in different ways at different times, so it's always difficult to put your finger on exactly what's causing it, and sometimes the catalyst can be different to the driver for gold. What I think is most important at the moment is the outlook for interest rates. Now, we've been in a low to negative real interest rate environment for quite some time. So you could argue that not much has changed, and the trajectory of rates has gone from maybe they're going up to no, they're probably still going down, which in itself isn't a massive change, but we've seen that wash through the market, we've seen it wash through the bond market, and it's causing ructions in the global equity market. But what that does to gold is when there's an outlook for rates falling, whether it's in a real or an implied sense, that is very good for gold. So when that environment is prevalent, gold will have an upwards trajectory. And it doesn't correlate in terms of when rates are at a certain level, gold is at a certain level. It just establishes the direction and not necessarily the magnitude. So we've seen gold go up because of that. Now, there's a couple of complementing things as well. Clearly, Donald Trump and his Twitter account are a big driver.
That's the most entertaining thing on planet Earth right now, isn't
it? Look,
it?
it's fun to watch from a distance, but it can have some pretty severe implications in some of the jurisdictions that he talks about. What I think they cause is a day-to-day catalyst. So people go, oh golly, Donald Trump is fiercely tweeting, gold's going to go up, and it does. There is definitely a self-fulfillment to that. But Donald Trump is probably $20 an ounce. Interest rates are probably $250 an ounce, if you get my meaning. So the longer-term economic trend, which is what interests me, is interest rates, because I can't see that turning around to being a positive interest rates environment for quite some time yet.
Yeah.
Now, cast your mind back to the last time that gold really ran, from the late 90s, early noughties, right through until sort of 2010-11. Gold put on about a 5 times multiple in that period of time. Now, I'm not sure that I'm that positive on gold just yet.
What's that, 10 grand?
Yeah, that'd be an awfully high price. And maybe you've got to get conspiratorial about that. That was driven by similar things. Interest rates went from having a positive outlook, controlling inflation, to interest rates dropping in order to stimulate activity. But at the same time, because gold was starting to move, the gold mining industry found itself with an enormous collective hedge position, which was becoming more and more out of the money by the day. So what was driving, I would say, big steps in the gold price at that stage was de-hedging by producers, and not just 5 or 10,000 ounces here or there. It was tons and tons of gold that had to be purchased by the industry and then sold into the market to clear their hedges. Now, we don't have that phenomenon at the moment. The hedging position is quite low and definitely manageable. You could probably wash through with a couple of years of production without having to buy it out. So I'm not sure I can see that immense driver to put many multiples on. But if we're talking the difference between 1,500 and 2,000 in US dollar terms, I can see interest rates doing that. What happens in that period of time, how long it takes, and where it goes to after that is the difficult thing to read.
Yeah, 100%. I think one of the things people used to say against gold was that it has no yield. But when we're in an interest rate environment where, they've gone negative interest rates before, and they've hinted at it. What was it, Philip? What's his name? Philip Lowe, or the Aussie guy was saying it the other day. And the US is, they've talked about it. It's been in the, other countries have done it. So it seems like if the market and the economy keeps going that way, they're going to go that way. So then gold becomes actually a pretty good investment. Like, you might actually get your money back. Whereas if you invest in these bonds and whatnot,
absolutely,
you're basically guaranteed to lose money, which just seems absurd.
Look, that's the point, isn't it? Gold has no yield, but neither do bonds at the moment. So what's the difference? Clearly, there is a difference. One is money, one is a commodity. People treat gold in a different way as well. Don't forget, it has a use as a store of value. And people behave emotionally about gold as well.
Well, I feel in the Western world, the India, China, they get the value of gold.
They do.
Russia and these guys. But, you talk to the average person on the street, if you offered them an ounce of gold or a Snickers bar, I reckon probably not Snickers, but like $100
if it was
or an ounce of gold.
Yeah.
I reckon people take the $100. I don't think people get it.
It's very difficult to perceive the value of gold, particularly if you show someone an ounce, which is as small as your little fingernail. Quite heavy, but if you're just showing it to them, it can be difficult. Although, having said that, gold in its purest form has a beautiful colour, it's got a real lustre to it, and I think a lot of people recognise that as a store of value as well. So then it's a question of, is that worth $100 or not? But remember, there was a time when gold was worth a lot less, and it was still seen as a store of value, particularly to a large part of the population. But it has fluctuated massively in that time, far more than a lot of other asset classes. The thing with gold is there is nothing which binds the top price, and there is nothing that binds the low price as to what it can go to. There is no fundamental that says gold can't go to $150 an ounce, because if the market is flooded with it, one way or another, or if all faith falls out of gold being a store of value, then that's theoretically possible.
Yep.
Similarly, $5,000 an ounce, whilst it's a long way from where we are now, is theoretically possible, because as long as people think that they need to keep buying it, and if the price is going north, people will, then 5,000 is well within reach, because there's nothing that can cap that off.
Yeah.
So it's when sentiment changes, and people often ask, do you think the gold price is going to go up or down? And for me, I think gold price goes up because the market thinks it should, and then it comes back down because it went up too fast. So, it tends to have a self-fulfilling ability to stop and start as well.
Yeah. Well, I always see it as like it's like you're saying, I see it as a store of value. I think for me, it's an opposite of it's a bet against the currency and the government. And for me, and I know a lot of people, and I take the conspiratorial path, I guess you could say, but for me, currency has always become worth less, right? And my thought is they always become worthless.
Yep.
And I think we're in that process now where you've got Russia and China and these central banks absolutely loading up on gold. You've got the World Bank, I believe it is, that's got the SDR that they're talking, or the IMF, I can't remember, and they're bringing in the basket of currencies, and they're talking about bringing in gold. So it seems like the world reserve currency might shift away from the US and even move to a basket of currencies, but as part of that have gold. And I think that's when you start talking about these numbers of 5,000, it almost becomes irrelevant at some point. Because fiat currency never lasts, and perhaps we're going to see that play out again.
There's been some very respected long-term commentators who didn't make outrageous calls They just were very sensible investors, and I'm talking about people who've invested in the gold market now as opposed to sort of general market investors. And some of their adages are that an ounce of gold will always buy you a nice suit. Or there was another one who had the adage that an ounce of gold will buy a nice lunch or dinner at one of the famous, I think it was the Savoy hotels in London. And that has held true. So 15, 20 years ago, that ounce of gold would buy more or less the same meal as it would now. You know, things change, but that's the effect of inflation, and I think that's where gold becomes the hedge for it. So if you think that...
Whereas in money terms, if you had whatever it cost then versus now, like it wouldn't get you anywhere close to it. Right? So,
Well, and if you think that in a couple of years' time, $5,000 would be the going rate for a nice suit, then perhaps that's going to be a self-fulfilling thing as well. So, and you know, I think you're onto exactly the right track there in terms of inflation. But that's what drives interest rates to a negative, is the impact of inflation on real yields.
Yeah. Well, we've actually got next week, Jim Ricketts.
Yep.
Yeah, he's coming on, so stay tuned for that.
That'll be
not just steal your thunder, Hedley.
No, I think
you're the Aussie gold guy.
He is a genuine gold expert, and I think your listeners will get a lot of value from that.
Yeah, and he's talking about $10,000 gold and kind of going down that path of, he's got the book, The Currency Wars, and things like that. So
I've got a few ounces he can buy from me for 10 grand an ounce if he wants.
Hedge it from now,
yeah, sure. Well, if he's that sure. Money where your mouth is, Jim.
We'll see. And what do you see happening in terms of the gold sector itself at the moment? Like, obviously, companies are loving it, but like you're saying, they've got a hedge and whatnot. What's your take? And
look, clearly a gold price increase has an effect on the revenue line for any gold miner. And we've seen gold miners in Australia perform well. They tend to perform fairly well in line with how the gold price is performing. So if there's volatility in the gold price, you will see the same reflected across the industry of producers. Below that, there are developers. Now, for quite some time, the developers and explorers, without a driver in their business, without a wonderful discovery or acquiring a project for very little, there wasn't a lot which was driving their prices. They would add news, and that might be positive, generate a little bit of buying, but trying to find a link between that and the gold price has been difficult. So there is volatility that reflects that, but not the overall trend as per the producers. What we've seen in the last, I would say, 2 or 3 months, and maybe not quite as long as we've seen the producers heading north, but we've seen one by one developers start to tick up as well. And you could probably equate this, if you want to be analytical, to each different project is going to have a gold price where its economics tick over from being they're okay to being they are now attractive, and the project is fundable, and the money starts to come for that project. Now, in some cases that's a lower price, in some cases it's a higher price. And don't forget that in order to take advantage of that, you need to be permitted. You've got to have your study in place. So you've got to have everything ready. You're just waiting for the price. It's opportunity meets preparation. We're seeing that now. And I think that what that's telling you is that the full price of producing ounces of gold over the life of those mines, so including the startup capex, you're starting to see attractive returns at the existing $8 gold price. So we're going to see mines funded. We've seen mines funded over the last couple of years when the gold price wasn't behaving this way. What we've seen in those population of things is not a huge amount of success. There have been some horror stories in the Australian gold market, and I think that has probably put some investors off quite a few. Institutional investors are still not so enamoured with gold that they're prepared to back things across the market. They're still risk averse. They want to see management of commissioning risk, management of permitting risk. They're a bit iffy on country risk. So we're not seeing that behaviour start to extend yet. I don't think it'll take too long. Within 12 months, if gold price keeps having an upwards trajectory, they'll have made money in some of their less risky stories, and they'll be prepared to recycle it into the more risky stories to try and go again. Profits breed greed, and I suspect that's what we'd see. So we're starting to see a bit of a filter down. Now, that's going to be quite selective, I expect, for a while. And it may or may not filter down into some of the miners, producers who have had challenges. They need to make sure they get their story right before they start to see the benefits of what the market's giving as well. Yeah,
that was interesting at the start of the year. Like gold price was taking off, and then you had the Evolutions, the Newcrest mine. All these big players were taking off, and the juniors were just kind of sitting around, and everyone's like, "What's going on?" So it did take a while to flow through. Maybe that's just people want to see the price keep going or stabilise, and make sure it wasn't just a a little blip. But no, even at the moment, you're seeing a lot of these juniors, while their share price is starting to go up one after another, they're getting their capital, they're doing capital raises and whatnot. So we've got something coming out on that soon. Just how they're taking advantage of that so they can move it forward and whatnot, which is good because for a while, the sector, everyone was just kind of like, oh, what's going on, the gold price? I mean, I was talking to the directors and they just didn't know what was going on, but obviously now it's starting to take off. So the other question, I remember the first time I met you was about 2-3 years ago, you probably don't even remember, but we were talking about buying gold or silver, and obviously we both do, not in the physical form, and you were saying, no, you should leverage it through stocks, and now when I see it, it's like, the gold prices move maybe 10-20%, but some of these stocks are going 100% plus type thing. So,
well, if you took the view that the Australian sector has seen the benefit of a gold price increase just during 2019, so we're talking calendar year, we're about 8 months through, of, let's call it 50%, just to put a round number on that, 50% increase on the gold price that you could receive. If you'd been in a basket of producers, you might have seen an 80% uplift. If you're across the ones which have had steady state businesses, no real challenges, no real massive benefits, just reaping the benefits of what's happening in the market. So you've already got the leverage into the producers there being 30% better than what gold has done. But then if you're in the developers, some of the more outstanding stories which have been close to production, had some funding in place in terms of having a banking mandate or something like that. They've hedged now, and perhaps they've had a catalyst come along, like a production team come in or something like that. I mean, they're looking at gains of 200% in the same period of time. So there is a definite leverage effect of having the equities and being across a number of them as opposed to just one or two, but also being across the development spectrum. So you have some producers, but you also have some of the things which can come up to meet them in the fullness of time.
Yeah, and what are your thoughts on, obviously gold's taking off at the moment, but so is silver, and I know we had this discussion the other day, but what's your thoughts on what's going to happen with silver, and is it seen still as a precious metal, or what's your thoughts there?
Silver's definitely seen as a precious metal, and no doubt it attracts buying when gold is going up. Silver I've always thought of as something which has a trend which might mimic gold, but it has volatility around gold. So, and that could be, you might have lags of months as opposed to an instantaneous response. The gold-silver ratio in terms of one price divided by the other has varied markedly over history. So
it's crazy now, it's 92 or 100 or something?
Yeah. So, I mean, that says to you there is an upward sort of drawing force which is going to try and pull silver with it. The difference that I see between gold and silver, and they both have industrial uses. Gold goes into electronics and dentistry. Jewellery to an extent, although demand for jewellery fluctuates according to what the price is doing. If jewellery is expensive, then people buy less of it.
Yeah.
If gold is expensive, do you stop putting it in fillings? Yeah, you can, but it's such a small part of the cost of having a filling, it doesn't really have a massive impact. Same with electronics. You use it for the benefit and not for the end cost. So, the cost of a stereo that's got a little bit of gold in it isn't going to fluctuate. It's not going to double because of the price of gold. Silver, on the other hand, is a probably larger cost in use for its industrial uses. And I would say, and I can't quote your numbers off the top of my head, silver, in terms of a store of value, is a much smaller part of the silver market than what it is for gold.
Yeah.
So I see silver as having industrial drivers, which will necessarily cap it. If it starts to go up, there's going to be a supply and demand response, whereas that operates completely differently in gold. What I said before was that you can notionally see gold going, very, very low, $150 an ounce as an example, or very, very high, 5,000, because the laws of supply and demand behave quite differently for gold. You can almost see that if gold goes from where it is now, call it $1,500 in US dollar terms, to 2,000, will that provoke more buying or less on the basis of it being more expensive? And my argument would be that if economic conditions have been maintained, it probably provokes more buying because people can see the trajectory and are happy to jump on the trend.
Yeah.
Whereas the same might not be true of silver. Now, I'm happy for people to argue otherwise, but my view is that silver's industrial uses are things which cap it and probably lead you to a lagging behaviour. It's going to be slower to try and react to go up, and it's going to be quicker to come back down when there's a downwards trajectory.
Yeah, it's interesting. I'm one of those silver people that I've got the argument for it, but I mean, I think they both kind of move sort of in tandem.
Well, I knew an investor, I still know the investor, who wanted to buy precious metals as a store of value purely for that. And he said to me, well, silver is cheaper So why wouldn't I just buy more of that?
The poor man's gold, that's what
Yeah, well, it is. But I said, well, how are you going to store it? And literally this guy was going to dig a hole and bury it. Not quite, but he wanted to seal it up. And if you're going to do that, you need a much bigger hole for the silver. Yeah. So, you can keep... I could have walked in here with $10,000 worth of gold in my pocket, and you would not have been any wiser. I could have walked in with $10,000 worth of silver, and it would have been a lot more difficult to get.
You wouldn't be moving, yeah.
So, which do you choose? Look, there's preference involved, and I think anyone who's going to use it as a store of value probably needs to think about how they think it's going to react to those different price drivers. But at the end of the day, if someone's got a bent on silver or on gold, it's going to be hard to talk them out of whichever one they prefer.
Yeah. And in terms of price predictions going forward, I guess let's make one and let's see if it comes true.
This is the worst part of any interview because I can see the drivers, but I'm always going to be wrong. And whenever I've called the price of gold before, it's actually led to a turning point. So maybe what I should say is that I think gold is going to maintain above $1,400 an ounce US, which means that it could retrace from here, but I think it will have some positivity beyond that. Remember, when things go up in a trend, they have down days. In fact, they have down weeks, down months in some cases. We saw that in the sort of 2000 through to 2010 trend for gold. There were some very significant down periods, followed by some quite significant ups, which always found a new high. And I think what we've seen in the last couple of weeks is gold has kind of burst through 1,500. It's gone up and then it's retraced back down. And if you're a chartist, which I'm not, but I acknowledge that there's a lot of those in gold.
We are, and we called it. I'll put them up on the screen now. We called the gold and silver like a week before they broke out. So if you read our stuff, you probably made a lot of money. If you didn't, too bad.
Well, you're the one they should be following, not me. What you'll find is that charting behaviour does influence the way that gold trends because 100%. There are so many people that buy into those things, and we will approach at some stage a point where the chartists say this is a new resistance level for gold. Now, previously, I think that was probably above 1,300, and to put some practical examples to that, gold would sort of fall to whatever was virtually analogous to the global marginal cost of gold production. So I said before, it doesn't behave supply and demand, but when it hit the point where gold supply was going to fall out of the market, that's where demand would go, oh look, it looks cheap enough, we'll start buying it again. Yep. And then there was a level, and I think it was emotional more than anything, just above 1,300, where the market would say, I've made some profits, I'm going to take them now, and that's what would drive it back down. And that was not only in the physical, it was also in the forwards markets, people trading futures, things like that. So we've pushed through that. A lot of those people who might have sold have said, well, we've got to hang on now, and there will be a point where they go, it's now logical to take profits. I don't know where that'll be. My gut tells me it's probably somewhere between 15 and 15.50, and I suspect that if you were to push through that, and look, the fundamentals haven't changed since we pushed through 1,300, so I can see it pushing through. It's just that you'll probably see some churn in the market as you get to that. And, 1,400 is a logical place to see it trade back down to. I'm probably putting a little bit more on it there, but I'd say it'll be a bit of a retest maybe, yeah. Which, from the point of view of producers, is wonderful. A lot of people say, well, if you can't make money at US 1,400 an ounce, you probably can't make money in gold, so don't bother. It's great for the market. Having said that, you asked about equities before, and historically when the gold price has gone up, in fact it doesn't matter what commodity it is, costs tend to follow. Your margin might remain reasonably static across an industry, but costs will follow the price up. So if long term we've got a margin in Aussie dollar terms of, pick a number, 400, 500 bucks an ounce, I think you're going to see costs rise to meet that in the fullness of time. Now, it might not be with every producer. There will some remain low and have the discipline to do that. But there'll be some that, in order to get themselves into business or to try and capture, the next part of market buying, will be spending money to try and achieve that. They're going to push the cost up as well. Yeah, and do you think, with that, now it's rising, these there's going to be a lot more merger and acquisition type activity, or what do you see in them? Absolutely. When there is money for gold equities, there is a greed factor which drives companies to want to be bigger. And they can see that the bigger they are, the more relevant they are to larger holders who will buy them on the fundamental perhaps of the metal and on the basis that they've fallen into an index that they need to own. Because isn't it, just to interject, isn't there peak supply? I remember doing some research recently and it looks like peak production is coming up, and these bigger guys are obviously going to need to keep stuff coming through. So that's correct. peak, I suppose you could probably take a view over the last 20 years or so of gold production and gold discovery and form a view that we've passed peak discovery and we could be passing peak production on those stats on the basis that global reserves are diminishing and it's going to be harder and harder to produce ounces without further discoveries. Now, having said that, there will be a point where call it the supply and demand response from that and the gold price in the market pushes to a level that gold, which is stored in vaults, becomes new supply, and that adds to the market. So gold doesn't get destroyed, it doesn't get stored in much, and most of the ounces which have ever been mined for whatever purpose are still, a store of value, whether they're a pharaoh's face mask or a piece of gold jewellery or a bar in a vault. They are all accessible as a form of new supply. So it's a funny one like that. I mean, unlike silver, particularly unlike iron ore, unlike copper, things get stored differently, and gold is one of those, which is a very mobile form. So, and on mergers and acquisitions, the examples we've seen in the last 12 to 18 months, we've seen two of the biggest gold deals ever in the coming together of Barrick and Randgold, Newmont Gold Corp. They formed in succession the biggest gold company in the world, and then they were leapfrogged to be another biggest gold company in the world. Those are a battle for size, and it's a battle for the dollar of generalist investors who, by becoming bigger, they've actually leapfrogged a couple of their peers, but also have become by far the biggest gold company. So if someone wants to put $1 into gold but isn't sure where it's going to be, and they've got billions of dollars to spend, they go, give me the biggest, safest, most diverse company, and now it's between Barrick and Newmont to get that. And, smaller companies are cottoned on, so that same effect happens as you ratchet your way through the smaller and smaller indices, ETFs and other funds. We've seen the merger of Silver Lake and Doré was announced when Silver Lake was about 45 cents a share. That was the price at which they were prepared to issue shares to Doré shareholders to bring the companies together. By the time that was consummated, I think they'd moved to 87 cents. Jesus. Now, nothing had changed in the business, but the market had said this is a bigger company. There are elements that now need to own it, certain ETFs and indices, and they did, and the weight of that buying pushed them up. And Silver Lake has since gone through about $1.20. So, these things can add value to companies without necessarily seeing a change in the business. Now, it doesn't mean that Silver Lake's business is diminished at all by having done that. It's just an example, but I'm sure that example provides tantalising little pieces of bait. It's a lure for a lot of other companies to try and think the same thing.
Yeah.
Now, to give examples, you could see a Saracen and a St Barbara, or a Saracen and a Regis, thinking that something like that's a good idea. Maybe a Silver Lake and a Ramelius would also be an interesting combination, because by doing that, they leapfrog themselves from being the sort of circa 250,000 ounce producer to being much closer to the 500,000 ounce. Now, they're just examples I've plucked. They're not. I'm certainly not aware of any really good rumours or anything else. It's just
feel free to
putting
share them
names
if you
to
do.
it. Well, people talk all the time about who might get together and what might make sense, but they're not giving out room keys to each other yet. So
no, it'll be an interesting space to watch, and look, we'll definitely get you back on, Hedley, as this gold market. Well, who knows where it's going to go? But
it's going to go up, Philip. That's where it's going.
I think so too. All right, thanks for joining us, Hedley. Appreciate your time and informing our viewers with your thoughts on the market.
My pleasure, and I look forward to talking to you again.